Yes, sir.
So they are not only telling you about the nature of business of the Smooth company, but they're also telling you about its customers, 3 large customers. So there is going to be some comment on this note. Okay, Duke did not borrow additional funds during the current year. So this is also something important, that it did not borrow any funds. So there was no change in the gearing. The following ratios have been correctly calculated based on the above financial statements. You've got receivable collection period, which has increased. You've got inventory holding period, which has decreased. So 2 things are happening. Receivable collection periods are increasing, inventory holding period is decreasing. There must be some relationship, and we have to, disclose, unearth that. What is the relationship? We have to understand. Okay, so we go down. It looks like quite interesting question. Other than the recognition of non-controlling interest and retained earnings, no adjustment is required to any of the other figures in the draft financial statements. All items are deemed to accrue evenly across the year. The first thing which they are asking you is to calculate the NCI. Calculate the NCI at 30th June 2008, which means NCI at reporting date, and it is for 6 marks. So your knowledge of consolidation will help you to calculate the NCI. And you know that they're asking you to calculate NCI at reporting date. And NCI at reporting date is equal to NCI at acquisition plus NCI share in post-acquisition retained earning. So what we have to do, your requirement number A, I'm starting this question. It says that NCI at reporting date. This is what we need to calculate. And we know that it is always equal to NCI at acquisition plus NCI's share in post-acquisition retained earnings. This is what we need to calculate. And NCI and acquisition, did they give you NCI at acquisition? Did they give you NCI at acquisition? How much was that? Do we have it? Yes?
Yes, sir.
How much is that?
3.4 million.
3.4 million. So NCI at acquisition is 3.4 million. And like usually we write down 3400. And then you need to calculate NCI at acquisition. And then you have to calculate NCI share in post-action retained earning. Post-action retained earnings of Smooth company. Okay. So this is where the NCI exists. So I will say that Smooth company retained earning. So Smooth company retained earning will say that profit as per financial statements. So how much is the profit for Smooth company for the year? Did they give you? How much is the profit for the year? This is. It says that Smooth company made a profit for the year 30th June 2008 for 7 million. Okay. So this is Smooth company's profit. When did you acquire Smooth company? Any information on that? You read the question. When the acquisition happened? It says that Duke Company is a retailer with stores in numerous city centers. On 1st January 2008, Duke Company acquired 80% of the equity share capital. So it is buying 80% and it is getting it on 1st January 2008. And the financial statements which are given, it says that Smooth made a profit for the year ended 30th June 2008. So you are making a profit of 7 million on 30th June 2008. You are acquiring it on 1st of January. So it means that how much period belongs to the post-acquisition period?
6 months.
6 months profit. We cannot take this full profit. We cannot take full profit for the whole year because our post-acquisition. So we will say that, you can say that profit as per financial statements, and I will write down post-acquisition 6 months. So it was 7 million, and I will take here 7 million divided by 2. Can you take this 3.5 million as per your profit? No, you cannot, because there are always some adjustments which you need to make subsidiary profit. Remember, fair value adjustment, extra depreciation. Yeah, extra. So we'll start from here. So it says that the retained earnings of Duke this was 13.2. I don't need it. Smooth company made a profit for the year ended 30th June 7 million. Duke company incurred professional fee of $500,000 during the acquisition, which have been capitalized as an asset in the consolidated financial statement. This is a wrong treatment. When you are acquiring this business, you paid some legal fee. This legal fee should be charged as administrative expense, but they should go as administrative expense of Duke company, right? It is not for the Smooth company because Duke purchased it. So this $500,000 should be subtracted from the profit of Duke. They are charging it to the asset. They did it wrong. Anyways, we don't need it now. Maybe we need it later. The following issues are also relevant to the calculation of NCI and retained earnings.
Why did they capitalize?
Because when you purchase the financial asset and transaction cost, you are adding on the top.
But this is not a financial asset.
This is not. Yes, this is not, and that is why I said that they are doing it wrong. I have to subtract it.
I'm just asking how can they capitalize, because when we do the capitalization, we divided the financial asset with the life, right?
No, it's not the asset. It is not an asset. It's not the life. It's not something which is going to be depreciated. It's a company which they are buying. So when they purchase the company for say 100 million or say 50 million, they pay 500,000 transaction fee, the legal fee, valuation companies. They just say okay, it is 50.5 million. They are adding it into the balance sheet as cost of investment.
Okay.
So it's not a depreciating asset on life. Okay, so this will go to the Duke company, profit will subtract. Now it says at acquisition, Smooth company's net assets were equal to their carrying amount with the exception of a brand name which had a fair value of 3 million but was not recognized in Smooth company financial statements, and it has a life of 5 years. So this is a fair value adjustment. In fair value adjustment, the net assets, they go up, but there is extra depreciation. So the subsidiary, the Smooth company, their retained earnings, their profit will be reduced by this. You would say that, adjustment for extra depreciation band, if you remember that thing. So how much is the value? It has 3 million value, right? And 3 million value has a life of 5 years, but you will take only half of that, 6 months. So this is going to decrease your retained earnings. This is going to decrease the profit of this Smooth company. So this is your, how to say, extra depreciation. Then what else is there? Then you have here, on 30th June, Smooth company sold land to Duke company for 4 million when it had a carrying amount of 2.5 million. 2.5 million. Okay. So smooth company. So what we need to do, we need to do it like intra-group profit. Intra-group profit. How much is intra-group profit? Uh,
1.5.
1.5 million. So I take out 1.5 million here. So this is also subtracted because they put it as profit 4 million, but 1.5 million we subtract from here. And now what happens that this is their adjusted profit of smooth company. So out of this profit, some part will go to the parent and some part will go to the NCI. And I would say that share of NCI and share of parent. NCI is 20% and parent is 80%. And I put like this 1.7 into 20%. And here we take this portion, this will go to the parent.
Sorry, where did you get the 1.5? The intra-group profit?
Yeah, it is given here. It said that on 30th June 2008, Smooth sold land to Duke. So it is intra-group transaction for 4 million when it had a carrying amount of 2.5 million. So it means that Smooth company which is selling, they are showing 1.5 million of gain, but this 1.5 million of gain is intra-group. So we just have to subtract it.
Okay, thank you.
So we finish with this thing. So now we've got our, this is share of NCI in post-acquisition retained earning, post-acquisition profit. So this is what we needed. We calculated it. And we say NCI at acquisition date was given, plus NCI share in post-acquisition, in post-acquisition retained earnings, post-acquisition retained earning of Smooth, which is how much? Which is 340. And we make a total. And this is, we got the answer. 3640. This is your NCI at reporting date. This they asked us. So one thing we just calculated here. So this is done. I think that everybody got it. It's not difficult. We did it in consolidation also. We are just repeating it. Huh?
Yes, sir.
Okay. Then what is the second requirement? The second requirement is, it said that calculate the NCI and calculate the retained earnings. Retained earning means the group retained earnings. So you have to calculate the group retained earnings as well as part of this answer. So you have
to calculate the NCI reporting date.
NCI at reporting date, like NCI on 30th June 2008, and they also ask you to calculate the group retained earnings.
Okay.
So you have to calculate the group retained earning. So group retained earning consists of Duke company profit. I would say that Duke company's profit plus Duke's share in Smooth, right? And Duke's share in Smooth was very clear, was this one. Duke's share in Smooth is given. We just calculated it, right?
Yeah.
Now we have to see what was the Duke's profit. So how much was Duke's profit? Let me just make it here. Duke company profit, let's go back and we see where is the Duke company profit.
12,700 is profit from operation.
No, that is,
Sorry.
This is from the group. This is for the group. Because you don't take this one because it says that is for Duke group. So these numbers are group numbers. I need group. I don't need group. I need Duke's individual profit. Duke's individual profit is given here. This one. Please read it. It says that Duke company in its individual financial statement. So group profit I will calculate. They are telling me that group profit is, I don't know, 14,500. I don't take this number. We need to make some adjustments. So we take the profit, which is Duke's individual financial statement profit, which is 13.2 million. It is given here. We start with 13.2 million and we will make some adjustments. So we go down here and we write down Duke individual financial profit is 13.2 million and we will make adjustments. Adjustment for acquisition cost. Remember $500,000?
Yes, sir. Administrative expenses.
Yeah, we subtract it. We subtract it. Then what else? Then what else? Group retained earning. I think that is all. That is all. Yeah. There is nothing else. I don't think there is anything else for the group. So I'll just take these numbers and I'll add this thing and I'll make a total. 14060. This is group retained earning. Any question you have, please ask. Okay. Please ask if there is any question.
Sir, we have group profit also, right, in the question.
Yes. That's 14060.
14,500.
Yeah. But it is not correct because they made mistake on retained earning and we have to calculate these two and then it will impact this one as well. Because they told you that they made a mistake on acquisition cost of 500,000, adding it to the asset, you have to subtract it. So you need to make some adjustments. Because the notes tell you that retained earnings are wrong. NCI is wrong. You have to calculate it again. Okay?
Okay, sir.
Then comes this next part, B part, which is ratios. You need to calculate ratios. Like we were doing the previous question. This question again has, it requires you to calculate some ratios and very simple ratios. You have to calculate the current ratio, then ROCE, return on capital employed, and you have to do the gearing. 3 ratios you have to calculate. And you've got here.
Can you give me, sir? There is a lot of disturbance, sir. Please mute, sir.
So we just have to calculate for 2007 and 2008. We go down and we need to calculate for 2007 and 2008. Let me put 2008 here. So first, like we did ratios in previous question as well. First, you should write down always your formula. So it is your current assets divided by your current liabilities. This is the best way of showing it. You show the formula, and then you should show the numbers, that how much are current assets in 2008 and how much are current liabilities, and then you divide it. And how do I do that? Current assets, if you go back, let me now pull it down, because we need to see a lot of these numbers, and we need to have it here somewhere. Okay, something else we need to pull down. We need to pull down this one also. Okay, so how much do you see your current assets?
Sir, we have to calculate group ratio, right? Consolidated. Yeah. So 30,400.
Your current assets are 30,400 divided by current liabilities. Okay, let's first do it for 2007. For 2007, your current assets are 28,750 divided by the current assets for the previous year were, and the current liabilities were how much? 15,600. 15,600. Okay, let me write it down like this. Okay. Divided by, I'm sorry, I need to write down again, 15,600. And when I take it here and I put this one, you get your current ratio. Always express it in 2 decimal places and always make it a bold. So this is your current ratio for, 2007. Okay. In 2008, what do you have? In 2008, your current assets are 30,400 divided by your current liabilities are 21,300. So it's very simple. It's easy. This is not challenging at all. You do it like this. You just need to spend time on that. That's all. Then you have to do ROCE, return on capital employed. So the formula is always PBIT divided by capital employed. And if you want, you can write down here as a note that what is capital employed. You can put it as a note that capital employed is equal to total assets minus current liabilities, or you can say that capital employed is equal to equity plus interest bearing debt. Any debt on which you are paying interest, which is your usually non-current liabilities. Non-current liabilities are always interest bearing. So I can call it non-current liabilities, I can call it interest bearing debt. So this is what you need to find out. So PBIT is given to us. How much is PBIT? Profit before interest and taxes in 2007.
12,700.
12,700. And how much is capital employed? Capital employed is equity plus debt. So what do you see in equity? In equity, you see your share capital, which is 8,000, which is 8,000, plus you've got share premium, 2,000, plus you've got retained earning, which is 9,400. And do you have any long-term loans? Yes, you do, plus 7,000. These are the things which you have in your capital employed. You can show it separately here, you can put it here, whatever method you want to do. So you come here and you put. Does everybody understand?
Yes, sir.
Yes, sir.
So how did I get these numbers? So it is equity plus debt. So I took my equity. So equity here is, let me show you guys again. So which numbers I took? I took my share capital 8,000 equity, share premium 2,000 equity, retained earning 94 equity, long-term loan 7,000 equity. This is not, I'm sorry, debt. So this is debt. These 3 are equity. You make a total of these 4 numbers. This will become your capital employed. And again, the same will go there. In 2008, you will take this one. You will take this one. And then you have to take retained earning and NCI, which you calculated in part A. And you have your long-term debt. Do you understand?
Yes, sir.
In 2008, they did not give you. You have to calculate which you did in part A. You just calculated your NCI and group retained earning. You will just put those numbers here, and then it will be done. So this is also not difficult. In 2008, what you need to do? In 2008, your operating profit is,
14,500.
14,500, and now I need to make it 2 big.
Sir, are we supposed to include NCI?
Yes, of course, because that is part of equity. Equity attributable to NCI, that is part of equity. 14,500 divided by your share capital of 11,000 divided by your share premium of 6,000 plus your NCI was how much? NCI was
3740.
Where is it? Where did you see it?
Above, sir. I have also written.
Yeah, 3740 is NCI and group retained earning are 14,060. So 3740 plus 14,060. So these are the numbers for your capital employed. You put it here and make an equals to sign. You get it here. Your return on capital employed has somehow
41.67.
41.67. It has gone down. Capital employed. Okay. Because why it has gone down? Can you tell me now? I can give you a reason in 1 minute. You know what? When I was teaching you the chapter interpretation of financial statement, I told you that a very, very, very typical problem with ROCE is that if you purchase some asset at the end of the year, your capital employed increases, the balance sheet value asset increases, but the asset has not given you full year profit. So you have not seen its impact on income statement, but you see the full impact on the balance sheet. So what is happening? That you are acquiring some business on 1st of January. You made some huge payments. You issued some new shares. You took some long-term debt to acquire this business. What you are doing? You are taking some long-term debt. You are issuing some share capital. You have some, so your capital employed has increased significantly, but your profits have not increased so much because you just bought it 6 months ago. So the impact on the profit is only for 6 months, but on the balance sheet, you take the full value, and therefore your capital employed has gone down. This is one point which I specifically mentioned, if you remember. Whenever ROCE, they will ask you to calculate such type of scenario will arise. Like we say that our, ROCE has gone down. It has gone down this year, but next year it may go up. It is going down because income statement is taking an impact of only 6 months, whereas in the balance sheet, we are showing all the values. Am I clear? So this is what I explained to you. This is what you are going to write down in the interpretation part. Right now here, we don't need to explain this thing. We just talked about it. But when you will do the third portion, which is the interpretation, then there you have to mention this one. Okay. Then we do the gearing ratio. Gearing, you have to calculate, equity and debt. You can say that, equity divided by equity plus debt or debt divided by equity plus debt. So I would take the formula debt divided by debt plus equity. Okay. and I will take the same numbers. Same numbers mean that how much is my debt here? My debt divided by debt over equity. So the debt in the first case, if you see here, in 2007, your debt was this non-current long-term loan was 7 million divided by debt plus equity. So debt plus equity was the same like you mentioned above, 8 million, 2 million, 9.4 plus 7. The same which you took capital employed before, okay? So you put it here and you take it down and you see that your debt equity is 26% or 27%, whatever. Debt over debt plus equity. Yes.
I cannot see your full screen. Sorry. Can you little minimize it here?
You have always two ways. There are always different methods of calculating gearing. Either you can do like this, or you can do like this. In exam, they will give you marks for both. Either you can say debt over debt plus equity, or you can say debt over equity. Both ways. I am doing it with debt over debt plus equity. Okay. And here it will be 11,500, my debt, divided by my equity is the same numbers which I put above, 11 million plus 6 million share premium, plus my NCI 3740, plus group retained earning 1460, plus my long-term debt of 11,500. So I put the same, all of these numbers. These are taking a lot of space, okay? You can just manage to see it. So you put it here and it has gone here. Please do not be scared. It is possible that in some cases, you can take, like I said, that I'm using it with debt over debt plus equity. There is an alternative calculation of this also. If
sir, just 1 second, sir, just 1 second. So can you check the first one? We have divided 7,000 by 8,000, 2,000, 9,400, 7,000.
Yes. Share capital, 8,000. Share premium, 2,000. Retained earning, 9,400. And long-term debt, 7,000.
Yeah, fine. And here, how come 11,500 again?
Because this debt again, like I divided with here. What I'm using debt over debt plus equity. So I used all the equity and I used all the debt. Just like this is debt, this is equity, and this is debt. So I'm using debt over equity plus debt.
And then why you're not doing here in 2007?
The same thing. This is my debt, this is equity, and this is debt.
No, sir. So 7,000 is also there, right? If you see above, 8,000, 2,000, 9,400, 7,000 plus 7,000.
Yes. So the formula is debt over equity. So how much is debt in 2007?
7,000.
7 million. And how much is debt plus equity? Equity is 8, 2, 94, and this is debt. Just like 7 you see here and you see here. Similarly, you see 11.5 here and 11.5 here.
Okay, and we have 11,000, 6,000, 3,740. Okay, retained earning we are adding here.
Yes.
Okay.
So this is one way of doing it.
Okay,
like
fine.
I use the number correctly. What I did is that I use the formula debt over debt plus equity. But sometimes you can say debt divided by equity. This is also one way of doing it. Whether you do like this or you do like this, answers will be different, but they will give you marks. If you want to do debt over equity, then you will say 11,500 divided by just equity. So how much is equity in 2008? In 2008, equity is 11,000 plus 6,000 plus 3,740 plus 14,600. And you just ignore 11,500, okay?
Yes.
So when you put it here, your ratio, your gearing ratio comes out to be 33%, okay?
Yes, sir, I was getting this.
It is 33%. So similarly, if I divide it here, I can just remove the portion of debt from here. So it will become debt over equity. And when I make it like this, so this is 36%. Both ways are correct. There is no restriction which one you should use. You can use any one of them, okay? Okay. There is never ever any restriction unless or until they ask you, but they never ask you. They leave it to your choice. Either you do this answer or you do that answer. It will all the same. Are we clear on numbers?
Yes, sir.
Okay. Now, there is only one last thing which is remaining for 10 marks. Use the information provided and the ratios calculated above. Comment on the comparative performance and position of the 2 years ended 30th June 2007 and 2008. Your answer should specifically comment on the impact of the acquisition of Smooth. Acquisition of Smooth. How this acquisition of Smooth will impact you. Your analysis, okay? So all your answer should be drafted based on Smooth, this thing. Now, I just actually, what I want to do, I want to stop here, take a break. When it's a service company which they are acquiring. And in service companies, your receivable days are always more because you deliver some service, it takes some time. Like when you sell some goods, the delivery of goods is done at point in time. So I give you the keys of the car, I sold you the car, and you give me the money. That's all. So receivable days are less in sale of goods. But in provision of services, receivable days are always more because the customer will pay when the service is done and the service will take some time to be completed. So receivable days are more. And this also, inventory days have gone down. This is also true because in service business, there is not much stock. There is not much inventory. So every question will have a different scenario. You will have to read answer once and twice and thrice to develop that understanding that how to analyze the data and how to draft your answer. But before you draft your answer, you should pay attention to the marks, how much marks they are giving. And you always make a conclusion in the end. End of the day, you have to conclude it. You have to address it point by point. Point by point does not mean that you should start writing point 1, point 2, point 3. Never do that. You have to put it as a report. You don't have to make it as bullet points. You have to make a report, but you know that what is the starting point and ending point of the report. For example, in previous question, we started with revenue. That was the first line. We talked about revenue. We talked about gross profit. We talked about operating expenses. We talked about operating margin. We discussed the reasons why operating margin has gone down. And then we went on to Samba, that what Samba was doing, why did we sell it? If we sold it, what would happen? So that's a very logical way of doing it. Never try to write long. You will not get marks for a long answer. I mean, you are writing something, on and on and on, which they don't need. You will get 0. You get marks, even if you keep it. There's a word, I would say that, which is perfectly used in SCCA, and that is called concise. There's a word in English language, which is called concise. Concise means that brief and complete. Like comprehensive is detailed. You don't have to give comprehensive answers. You have to give concise answers. Concise means that it is complete, but it is short. So be short, Don't give and don't think that if you will write little long, you will get more marks. Marks are not given for length. Marks are given for the points you are addressing. All important points in logic, you in logical sequence you address them, and you will get the marks. And end of the day, there is no perfect answer. There is no perfect answer because it is opinion, it is interpretation, it is understanding. Your understanding could be different than my understanding. The important thing is that on fundamentals we should agree, but our stress could be different. There's something which I pay extra emphasis, and you see that it's not very important. You just touch it and go, and I put more emphasis. It is possible, but fundamentals should be correct. Please read answer. Go to Google and do it now because it is fresh in your mind. Just read the interpretation. If you want, I can do this for you. Do you want me to do it? Interpretation. I'm doing it for you. I'm not letting you people go. I've just opened this thing. It is opening in front of me. So let me share. It is here. So we got here the answers. I have not downloaded it. I just opened it from there, and here we go. Okay, so let's check our answers. Yeah, 3740 is NCI. We got the same number. 1460 is the group retained earning. We got the same number. Their way of doing calculation is different. They are calculating 80% of everything. I don't do it. I calculate total and then make 80%. Okay, this is not a good way of doing it. I don't like it.
Actually, this is more complicated. So if you do some mistake, entire answer will be wrong.
Yes, it is not a better way because what they are doing, they are making 80% adjustment to everything. I would say that first calculate the profit of smooth, the adjusted profit, then give 20 to NCI and 80 to that. Split 80-20 later. They are splitting everything. Like, this fair value depreciation, they are taking separate. Not a very good idea. I don't like it. Anyways, no comments. We move further. Ratio analysis we did. Okay, how did they do it? Okay, they did gearing, Ankit, with your method. They did gearing without debt. They were doing it debt over equity. So they are not adding this 11,500 here again. But I would do it. It makes no difference. And then what I want you people to read here is performance. This is what you need to read. Can you people see it or do you want me to make it bigger?
No, sir, we can see.
Please read it in 5 minutes. Before we close the session, just read it. So, reading this one?
Yes, sir.
You see there that this is because of the acquisition of this smooth company. ROC has gone down. The new shares, you took the debt, your capital employed has increased, but the profit has only come for 6 months. After tax, 7 million is for 6 months. If it had been full 1 year profit, your ROC